Good morning, everyone. I'm Greg Taylor from Salter Brothers. Appreciate you joining the call. We're just waiting for a handful of people to complete the log on process, so we'll get started within the next minute. Thank you again. Okay, look, I might make a start. We're still a couple of people to join the call, though, as is often the case. Um, we will have a recording of the call and make that available to all investors and will be publicly released as well. But well, thank you all again for taking the time for this month's webinar. My name's Greg Taylor. I'm the head of the equities business at Salter Brothers, and today we're going to give you an update and a bit of a review on the FY25 year, and with the focus around Salter Brothers Emerging Companies Limited, which is the listed investment company under the ASX code SB2. But if we'll just jump forward to the agenda, there, as I said, today's webinar is very much a bit of a year in review for the FY25 period, the 12 months through to June 2025, both from a macro and market perspective, and then obviously we review the portfolio of SB2 also. Then we dive into just a few of the current drivers and metrics of the portfolio, and then we finish up with a bit of an outlook and portfolio positioning discussion. So we'll jump straight into it again. So just a bit of a recap. We've got a couple of new people on the call today, so just opening up in Salter Brothers Emerging Companies Limited is a listed investment company, and importantly, it's dedicated to investing in small cap Australian companies listed on the Australian Stock Exchange with a market capitalisation of under $500 million. So very much a small / micro cap equity product with an Australian focus. The fund has now actually surpassed its 4-year track record, and we'll dive into the performance a little bit later in the presentation, but has consistently outperformed the market during that period, and for the 12 months through to 30 June 2025, performed largely in line with market with a 6.34% positive return. It was quite an important year for the fund as well. It announced the inaugural dividend of the fund, which was the half-year interim dividend, and due to provide a further update on the dividend in August with the full year result, though the expectation is that dividend will absolutely continue and remain fully franked. And also touch on another metric of the portfolio that does attract a lot of interest and discussion is around the discount it trades to the underlying net tangible asset value of the portfolio, and still sort of stubbornly sitting there around 30%. We'll talk a little bit more about why that hasn't moved as quick as we had hoped, and some of the elements and drivers we've put in place to try to close that discount. All right, if we jump over the page, again, it was a pretty remarkable year when you look back from a macro perspective, and there was a lot of key events both domestically and globally, and this graphic here sort of just highlights a few of those. And first one I'll point you to is early on in the piece, as we sort of in 2000, the September October period of 2024, when the US first cut rates, you'll see the small caps really did outperform, which a common dynamic I speak to about this inverse relationship between interest rates or the direction of interest rates and the returns of the small cap market. And what you'll see there is when it was clear that we're going into an interest rate cutting cycle, you saw that period between October and November where there was quite solid outperformance within the small cap market relative to its large cap counterpart in Australia. Then over the next 6 months, the two markets traded pretty similarly, despite some pretty large global macro developments, and including those was obviously the President of the United States, who was inaugurated and then went about his business and caused quite a lot of disruption and confusion and I guess uncertainty in the global investment markets. But despite all that, the two market, the small and large caps, there obviously is a big sell-off we saw around the April period of 2025, but that's all been recouped and a little bit more so for the larger cap stocks since. So yeah, fascinating year. If you it's a good result that both markets were in positive returns. There was quite a lot of volatility, which creates opportunity, but hopefully a little bit more stable year as we go into 26. But if we jump over the slide, there's a few more key metrics we point to, and the one that retains our conviction in why it is a prudent time to have some exposure to Australian small cap equities is the valuation differential between itself and its large cap peers. So the two reference points here we've used is the ASX 100 benchmark, which is your large multi-billion-dollar Australian companies, from your banks to your resource companies and retailers, and contrast that with the small ordinaries, which is the smaller cap stocks. And what you've seen here is, it said through time, all the way back over the last 20 years, there's absolutely times when small caps are, because they're in superior growth rates and stable macro environments, trade at higher multiples and valuations to that of their large cap counterparts. But over the last sort of 2 to 3 years in particular, we've got this phenomenon where large caps valuations are, beyond one standard deviation of where they have been through the 20-year history, and that's north of a circa 13% premium to the long-term average, and small cap. So history will tell you that those things will revert, and I think the relative performance of large caps versus small caps here, it appears it's a lower risk outcome to expect that small caps to outperform large caps over the next 2 to 3 years. But if we jump over the next slide, a couple of the key index performances of FY25, the last 12 months, which is really interesting reading as well. So the first two columns there on the left is around the small cap sector in Australia, split between the industrial sector and the resource sector. And a real disparity of returns, especially if you look at that 12-month period, where industrial stocks only delivered around a circa 5% return, whereas the small resource stocks dominated by gold, and the gold stocks had a very strong year. You saw that in delivering 18% plus return. So for a fund such as SB2, we do not have any exposure to resources. And so our relative index was that circa 5%, which is where our performance, was a little bit on top of that. We'd outperformed that, but the broader small cap market, we'd underperformed due to that outperformance of the resource sector, and especially the small cap gold companies. But if you flip a couple of columns over, you'll see the ASX 200, which is more your mid to large cap Australian companies, and it was an inverse there. The industrial companies had very strong performance, north of 20%, whereas the large cap resource companies, very poor returns with -7%. So, yeah, really interesting dynamic between the large and small caps and the split between industrials and resources. Uh, and then the last two columns there, or rows there, have got the Russell 2000, which is the proxy for the global small cap index, and that was a positive, circa 11% return. Then the S&P 500, which is the global or the US proxy for the large cap companies, also had a very positive year of circa 12%. So jumping over the slides again, you'll see just what sectors within the Australian market performed, and we've spoken a little bit about the resource companies versus industrials, but going down into a little bit more detail, the top performing sector was the financials, and that was predominantly driven by a couple of the large banks which had very strong year of performance, and some of the larger tech companies as well, and telco. So the top three sectors of that. And if you look again, healthcare had quite a negative year, as did the materials sector as well. So again, just shows quite a lot of volatility quarter to quarter, and then also over the 12-month period between the various sectors. So jumping over the slide again, what we'll see is again just a graphical representation of the small cap industrials versus resources, and the grey showing the outperformance of the gold sector, which led the resource sector higher over the course of the year. And then if we turn over to the next slide again, what we'll see is the relative performance of SB2, the NTA of SB2 portfolio versus series of global indices, and this measurement periods from effectively the start of 2024, so 18 months. And what you'll see is the black line is the underlying asset performance of SB2, and that's been quite strong and consistently outperforming most global markets, including small cap domestics, large cap domestic, large cap global, and small cap global. But in that last sort of 3 months of the year, the large cap US sector had a very strong performance, and has shot to record highs again, which is somewhat confusing for many in the market, considering the uncertainty and volatility, especially in the US market. But what I think the large cap techs had a very good period, which probably is much driven by the view on interest rates, and which continue to fall globally. Jumping over the slide there, Megan, we again just the performance of SB2. Again, the last 3 months has been a tough period for the portfolio versus the index. One, we spoke about that industrial versus resource sector, but also a couple of our top performing companies have had, our top largest holdings have underperformed the market over the last 3 months. And I'll talk to that in a little bit more detail shortly, but really strong of the view there's not fundamentally anything that's changed with those companies. There's a little bit of noise in the market that's causing short-term volatility, but we're of the view over the next 3 months, as we enter into the reporting season and some factual data will come out, and some key catalysts in those stocks, we should hopefully see a reversion of that performance. But again, over the 12-month and longer term periods, the performance has been quite solid. Jumping over the slide again there, Megan, with just a little bit of the composition of the SB2 portfolio over the year. And what you see here is there is quite a lot of active management of the portfolio. So you've got the key additions. These are all new holdings that entered the portfolio that weren't there at the start of FY25. Then a few of the key sales or positions that we completely exited during that period as well. So again, quite a lot of change. I typically say on average we should turn over about a third of the portfolio each year, and considering we hold about 20 to 25 names in the portfolio, that turnover of sort of high single digits per year is pretty consistent with what we would expect. But importantly, pretty excited about how the positioned for the year ahead. But just a bit of an attribution analysis on the right here for that 12-month period through to June. The top 5 performing stocks are listed there. So the pleasing thing is 3 of those are top 5 holdings in the portfolio. A couple of those being AI Media and Alfabs have been underperformers during the last quarter, but very strong performers for the 9 months through to March. Gave up a little performance during that June quarter, but confident that there's still quite a lot of upside and we might see some reversion of that short-term underperformance in the coming months. And then, another exciting one is that Worker is one that we added to the portfolio this year, and that's gone quite well. And then just showing the selling discipline, there was a holding there in a small cap company called Pure Profile, which had very strong performance in the first half of the year, and we sold into that strength and exited that position. Okay, jumping over the slide again, just a little bit on the outlook. And so there was a lot of volatility in the last 12 months, which is never good for smaller micro caps. And so I think that the key factors that drove 25 will remain in FY26. But the first one there is around interest rates. We've done quite a lot of research papers, and I've spoken in previous forums about that key relationship between interest rates and small cap equity performance. And typically, a falling interest rate environment will see, and in a sustained low interest rate environment, we'll see outperformance of growth orientated small cap stocks, which is very reflective of the portfolio that we hold. So a good environment expected there. The RBA surprised a few in the Australian market, probably including myself, that they didn't reduce rates at the latest meeting, but the consensus remains that was only a delay and likely to continue at least 3 more downward moves in the domestic interest rates over the next 12 months, which should be conducive to some better performance for the sector. Obviously, there's quite a lot going on globally, geopolitically, whether it's the Middle East and many other things from Russia and Ukraine through to Israel, Iran, and obviously the US seems to be having difficult conversations with many, and then there's always what's happening over in China and the continued focus around the Taiwan element there as well. So they're things we can't control. Again, there's been a lot of geopolitical instability this year, and we've still seen positive returns for all global markets. So hopefully we don't see any further acceleration in that volatility, but I think again the market and environment remains for a positive return scenario over the next 12-18 months, even with those factors still in play. The other one's obviously still tariffs, which is back on the news headlines again as the US and President Trump keep jumping around and finalising their decision there. Again, during the year, we did a detailed research paper, which is available on our website around this topic. As expected, it does cause short-term instability and uncertainty, but over the longer term, we're of the view that it shouldn't have any systematic and major change in the way the global markets operate, and we think the markets will adjust accordingly. The other one just to keep an eye on is around exchange rates. Obviously, a lot of the companies in the portfolio have global exposure from an operating perspective, and predominantly in US dollar exposure, and increasing talk around the risk of a devaluation of the US dollar. And what that might mean for the underlying companies, and just more broadly, the global investment markets will remain a watch point for the portfolio. But if I jump over, it's the same slide we offer every month, which just provides a bit of a recap or a snapshot of the top holdings in the portfolio, there's been no changes in the last few months of these top five. I have spoken about the underperformance of Alfabs and AI Media over the last sort of 3 months. There's been no data points released. It's as much a void of new information that's off the back of 9 months of strong performances has seen those stocks drift a little bit. And again, really positive that as we get through the reporting period over the next sort of 1 month, especially Alfabs and AI Media, I think we'll be able to reiterate the businesses are very much on track with the thesis and why we're holding those companies, and both have significant upside remaining. The other one that has really hurt performance over the last few months is Better Entertainment, BBT, which is the Blue Bet sports gaming company. It's caught up in a bit of a takeover battle for the PointsBet business. So it lodged a takeover offer for PointsBet, and it's got a bit of a bidding war going on with a Japanese private company that's pursuing that as well. And that's caused a lot of uncertainty and volatility in that share price. So it's probably still another 4 to 6 weeks for that to play out. So and so it's probably going to continue for that volatility, I'd suggest, for the next couple of months. But fundamentally, the underlying business, let's just think about a scenario where they are not successful with the PointsBet acquisition, is still very well placed, very well capitalised, profitable company with still strong synergies, and there are other acquisition opportunities available in the market which we're confident that they would be able to execute on in the event that they were not successful with PointsBet. So again, increasingly as the stock price has fallen, this is a strong company, very well managed, growing market, and still very strong balance sheet and a number of inorganic growth opportunities ahead of it, which is materially undervalued at the moment. But market doesn't like uncertainty, and until that all clears up, I think we'll just have to be patient with that one. But I think in 12 months' time, we'll look back and be surprised if that company's not one of the better performing stocks for the 12 months of FY26. And again, I continue to just talk to the metrics of the portfolio. But as we go into 26, we're still, we've got a portfolio that has revenue growth, weighted average revenue growth north of 20%, expanding profit margins, and conservatively valued. So we still haven't seen that valuation gap close between large and small caps. I really do believe that it's going to happen. It's not if, it's when. I'm of the view that it should play out over the FY26 year, and the portfolio is extremely well positioned for that scenario. And again, our weighted average upside for this portfolio is north of 70%. And so if the market does get a bit of positive momentum, the upside's meaningful for the portfolio. So jumping over the slide, just again, we just talk about this discount, which we have spoken about over the last 12 months, and it's a byproduct of a couple of factors. One is just small cap sentiment. I think once small cap sentiment does improve off the back of the reasons that I've articulated, I think you will see that gap naturally close, but we're not sitting there relying on that. The other really important aspect is portfolio performance of the underlying portfolio. As I've touched on in this forum, I'm very confident about how the portfolio is positioned going into this coming reporting season, and also as we go into the FY26 year. So that they're the key drivers. But in addition to that, we do have a buyback in place. We've been a little bit reserved in the buyback of recent months, but that will accelerate again as we get through the reporting season, and make sure that we've got sufficient liquidity in the portfolio, and we'll continue that share buyback. In addition to that, again, I've spoken about the dividend. The annualized dividend yield probably north of fully franked dividend yield north of 6% now for SB2. And that's on the assumption that the interim dividend of 2 cents is replicated again as a final dividend in August, which is consistent with the expectation. The other factor that's been in play, which is we've had a real rotation of the register within SB2. There was a number of sort of unnatural holders within the portfolio that was north of 50% at the start of last year, and that's now moved down to getting down towards 10%. And what that has caused is a bit of an overhang, i.e. more sellers in the market. And as we're clearing those sellers out and replacing them with medium to long-term focused investors, I think you should see more normalised trading as well. So, we're continuing to do active marketing, building awareness, working with individuals as well as wealth management groups and advisory networks to increase the awareness, build up the buying, and continue to close that discount. And really believe we are, that discount did get out to 40%. We got it down to 26%. Bit of the short-term volatility in the market, seen that drift. But I remain confident that we can get that discount down over the course of FY26, which will be additional performance for investors in SB2 over and above the underlying portfolio performance. And then just jumping over the page there, I think we are largely done. Again, just to reiterate, volatile year, very strong performance for the fund in the first 9 months. We gave up a little bit of performance of that in the last 3 months. I really have the strong belief that that's a short-term phenomenon, and we're extremely well placed for the next 12 months for the fund. And I think good tailwind will be the small cap market off the back of what is a improving valuation environment for small cap equities in Australia. I'll pause there now and see if there's any questions that anyone can offer via the chat function. And if you don't have the opportunity or don't want to ask the question now, my details are provided at the back of this presentation, and the presentation has been released to the ASX. So feel free to reach out to me directly, and happy to take any questions or comments offline as well. But I'll just pause. Megan, are there any questions there at the moment?
Not at the moment, Greg.
Okay. All right. We'll call it a day. Again, appreciate everyone's time today. Look forward to the next update, especially off the back of the reporting season. And again, any questions in the interim, please do not hesitate to reach out. Thank you again, and goodbye.